If the top 5 companies in the market dropped 20% tomorrow, would your portfolio survive it? Most investors would say yes. Most investors would be wrong. You probably think you're diversified. You own an index fund. Maybe a few big stocks. Maybe an ETF or two. It feels spread out. But diversification is not about how many tickers you own. It's about what actually drives them. And right now, most portfolios are far more concentrated than people realize. Here's the proof. Today, the top 5 companies in the S&P 500 make up roughly 25 to 30% of the entire index. That means nearly 1/3 of your diversified portfolio could depend on 5 companies. Not 50. Not 500. 5. And the top 10 often represent more than 35% of the index. That's concentration, not diversification. Now here's where it gets uncomfortable. Those companies are not just large. They are driven by similar forces. Technology spending, artificial intelligence, digital advertising, cloud infrastructure, consumer platform economics, different logos, same macro drivers. If rates fall and growth accelerates, they move together. If rates rise or earnings slow, they move together. Correlation increases under stress. Let's go back for a second. In 1999, investors believed they were diversified. They owned index funds. They owned the market. They owned technology leaders. But the Nasdaq was heavily concentrated. When the cycle turned, the index fell nearly 78% peak to trough. Diversification failed because exposure was clustered around the same narrative. Now fast forward. In 2022, interest rates surged at the fastest pace in decades. High multiple growth stocks led the decline. Many investors holding broad index funds watched portfolios drop 20% or more. Why? Because leadership concentration was extreme. It's not about whether technology is good or bad. It's about structure. Now let's run the math. If the top 10 stocks represent 35% of an index, and those stocks fall 20%, even if the rest of the index stays flat, the overall index drops about 7% purely from concentration. That's before panic. Before contagion. Before rotation. That's simple weighting. Now add something else into the equation. Interest rates. For over a decade, the 10-year Treasury yield averaged below 3%. At times, it was below 1%. Low rates justified high valuations. Future earnings were discounted at extremely low levels. Today, the 10-year has been trading above 4% in recent cycles. That changes the math. When the risk-free rate rises from 1% to 4%, the value of distant earnings declines. Growth stocks become more sensitive to small changes in expectations. If your portfolio is concentrated in long-duration growth assets, you are rate-sensitive. Even if you don't realize it. Now here's another layer most people ignore. Owning multiple ETFs does not equal diversification. If you own an S&P 500 ETF, and a large-cap growth ETF, and a technology ETF, there is significant overlap. You are stacking exposure, not spreading it. It feels diversified because there are different labels. But the underlying holdings often look very similar. This is the diversification myth. Counting positions instead of measuring exposure. Now let's zoom out. The US equity market represents roughly 55 to 60% of global market capitalization. If your portfolio is entirely US large cap, you are geographically concentrated. Emerging markets respond differently to commodity cycles. International developed markets respond differently to currency shifts. Different regions move on different policy timelines. True diversification means exposure to different economic drivers, not just different company names. Here's the part that matters most. Risk does not build during panic. It builds during comfort. When markets perform strongly and volatility is low, investors increase exposure to what has been working. They reduce hedges. They increase allocation to leaders. They assume stability will continue. Volatility, measured by something called the VIX, which tracks how much movement investors expect in the S&P 500 over the next 30 days, has historically averaged around 19 to 20 over long periods. When it drops below 15 for extended stretches, markets feel calm. Calm markets encourage risk-taking. But when volatility eventually rises, correlation rises with it. Assets that seemed independent start moving together. Diversification weakens exactly when you need it most. That's not fear. That's structure. So what does real diversification actually look like? It means exposure across different drivers of return. Large cap, small and mid cap, international markets, different sectors, fixed income across maturities, assets sensitive to inflation, assets sensitive to growth. It means not relying on one outcome. If rates fall sharply, growth stocks may outperform. If inflation stays elevated, real assets may hold value. If growth slows, defensive sectors and bonds may cushion volatility. A resilient portfolio survives multiple scenarios. A concentrated portfolio depends on one. Now ask yourself something simple. If the 5 largest companies in your portfolio decline 20%, do you know exactly what that does to your overall exposure? If interest rates move another 0.5% higher, do you know which holdings are most vulnerable? If earnings growth slows across technology, does your portfolio have offsetting exposure? Most investors cannot answer those questions clearly. That is the wake-up call. Diversification is not a feeling. It is a structural design. It requires understanding weighting, correlation, and macro sensitivity. It requires looking under the hood. Because markets reward momentum in the short term, but they reward balance over full cycles. The goal is not to eliminate risk. The goal is to avoid invisible concentration. If your portfolio depends heavily on 5 companies without you fully realizing it, that is not diversification. That is concentration with better branding. And when leadership eventually shifts, that illusion becomes visible. The question is not whether today's leaders will continue performing next quarter. The question is whether your portfolio can survive if they don't. That's the difference between feeling diversified and actually being diversified.